We're here to empower high-income earners to gain back control of your time through financial independence and stop trading your time for money and start letting your money work harder for you.
And hey, if you want to meet other high-income earners on their FIRE journey, join our High Income Earners FIRE Facebook group. Every month, we'll have guest speakers and we'll share about what our team is currently working on and allow you to share what you are working on with other high-income earners.
Hello, everyone. Welcome back to High Income's Earner FIRE podcast. I'm your co-host, Cody Ye. Again, Aline Prague is not here today. We're still waiting for the day he's coming back to give us the feminine and the female version of this channel. But for the time being, today I have a very special guest. He is the expert in rent to own. His company, Jack Properties, has done over 250 rent to own. So I'm guessing he knows a thing or two about rent to own. And of course, he does more passive investing in real estate and some keynote speaking, but I will not butcher his introduction. I just want to welcome Alfonso to our podcast.
Oh, thank you. Thank you so much, Cody. It's truly an honor and pleasure to be here with you today. The amazing content that you put out through your podcast and through your other channels, social media, website. I've seen you speak. I've seen you at multiple, networking events as well too. Your vast knowledge and what you do for the real estate community, the investing community as a whole. It's to be admired, and it's just an honor to be on here. I'm an avid listener of the podcast as well too. So it's great to be with you and sharing my story here today.
Yeah, thanks for coming on. So, a 1 minute synopsis. How do you get to where you are right now?
Oh boy, 1 minute. Okay, here. We already started the fire round. Okay, so 1 minute. You know what? Working full time in different sales jobs and different, hunt or eat what you hunt type of careers and different types of sales and window coverings, small parcel delivery, that kind of stuff. And then the Rich Dad Poor Dad book. Not unlike many others that read that book, Passive Income Investing. Educated myself, took some courses, took some training. I had some really, really influential mentors and guides in my life that guided me towards, real estate investing. And then it was, all the different types of strategies that you can implement in real estate. And the rent to own spoke with me. I partnered with my business partner on the first ever real estate investment I made. It was a rent to own in Welland, Ontario in 2014. That we invested on that deal. And haven't looked back since. So that's how it kind of all got started, from reading the Rich Dad Poor Dad book, educating myself, getting into networking rooms, listening. At the time there wasn't a lot of, information like there is now with podcasts, but, different books, different networking events, and meeting people, and then really kind of just going, 2 feet, 2 arms, both ears, all the way into rent to own and kind of developing and growing the company from there. So maybe that was more than a minute. So sorry about that.
No worries. And you're Italian, first gen, second gen immigrant?
Yeah, so I'm a first generation Canadian. So both my parents were born in Italy, but they came rather young. They were both under the age of 10. I think my mother was about 6 or 7 when she came into Canada. But I got to grow up around my grandparents that, they immigrated here when they were in their 30s. And yeah, I consider myself very fortunate that I had 2 sets of parents, that my grandparents, that was the old school mentality that grew up in, the farming communities and, grew up through some very difficult times, didn't know the language. And then I had my parents that, lived most of their life in Canada by the time I was born, and that, assimilated and spoke the language. So very, very fortunate, very proud of my culture and heritage, as, many, many people are. I learned a lot of lessons from both my grandparents, parents, how to work hard, how to treat people, definitely how to eat a few bowls of pasta in my life, that's for sure. But it was a wonderful experience kind of growing up and learning both sides of that. So yeah, definitely something that I'm proud of.
Mm-hmm. Not to be stereotype, but a lot of Italians do learn about real estate early on in their childhood. Is that the case for you?
Yeah, you know what? For myself, I'll speak for myself, but then I'll explain my grandfather's story. My first job, I guess if you want to call it a job, it was summers in elementary school when I was in grade 6, 7, and 8, was with a family member, like a second, third cousin that was a builder. So they actually built, custom single family homes. And I was on the job site sweeping up sweeping up the homes, working with the bricklayer, the carpenter, the electricians. I was kind of their gopher of going to the truck and get this, or hey, the bricklayer, helping them out. So I was exposed to real estate, at a young age, because I was like, oh, wow, they're building homes. And then, I met the realtor that was selling the home. So I was exposed to it at a pretty young age, probably at, grade 6 or 7. But I just thought, oh, that's how you invest in real estate. You have to buy land, build homes, and, sell it or work in real estate as a realtor or a mortgage agent. But my grandfather, who came and immigrated in the mid 60s, he didn't know how to qualify for financing, credit worked, all that type of thing. He had a family member that was here about 5 or 6 years before him that had gone through the process, qualified for financing, got their own mortgage. Because again, and this is, directly a story from my grandfather, is when you were lending or borrowing money, from in Italy, it was quite scary. It wasn't like, document and warnings and things like that. It was, talk about hard money lenders. I think it might come from like how hard they hit if they didn't pay back, right? So sometimes there's...
Is it more like Godfather style?
Yeah, again, I can neither confirm nor deny, but it was quite scary when an Italian had to borrow money, right? So when he came to Canada, he still had that mindset of, I'm not going to borrow money, because what if I can't pay? I'm going to put my wife, my grandmother, his daughter, my mother in jeopardy, right? Of repercussions. But luckily, he had the community of other Italians that have been here a little bit before them, in the same way that we talk about in real estate when we work with guides and mentors and trainers and coaches that have walked that path before him. So he was able to be exposed to that fairly early on when he got that. And it changed the trajectory of my family's life, that he was able to purchase a home, get into the market. Now, he worked hard, worked extra jobs, all that kind of thing. I think he only had a mortgage for about 5 years after he bought the home, because he didn't want, to have that debt
double down,
over his head.
Pay off.
Yeah.
So going from having some exposure at grade 6 to 2014, in between, did you have any exposure to real estate?
Yeah, there was, different friends and, schoolmate people that we worked with. One of my college professors was a real estate agent, right? And we got to,
Did you make more money as a realtor than an actual professor?
I think so, because there was some classes that we got to get out early, because he would take, at the time, it was a pager. He was still working on a pager.
Yeah.
And he looked at his pager. He's like, okay, clock dismissed. I got to go do a showing. Right. And we're like, what? Right. So, and I spoke with him. I said, you're leaving that. And obviously I thought, hey, you're a college professor. That's pretty significant job. Well, why are you also doing real estate? And he explained some of the benefits. But, some of the exposure I had was just really around the conventional way, the normal way of buying real estate, or, other people that had other friends or family members that had, the normal rental properties that were just, always, talking negatively around it because it was around tenants. And all the tenants aren't paying on time, and they're destroying the property, and I have to go through the landlord tenant board, and now I need to fix this, and they ruined that. So that was kind of a lot of the lens or the perception that I had around real estate and real estate investing, until I read, the Robert Kiyosaki book. In 2014 was the first investment, but I really started to immerse myself in and around real estate education, probably around 2011, 2012, just shortly after the big market crash, or the big crash in the US, probably the end of the first decade of the 2000s, right? So, that was most of my exposure, was just conventional. It wasn't about multifamily or rent to own, or, burring, or I don't even know if it was called burring back then, right? Those types. Yeah.
So I know you Rich Dad Poor Dad, you probably went through a similar, coaching program, all that. They teach you everything from active to passive. Why did you pick rent to own?
Yeah.
And why do you stuck with it?
Yeah, you're right. We went through all the different strategies: passive, active, wholesaling, multifamily. The reason, and I took like the full package. There was 8 courses, the mentorship. So I really, really went deep on all the different types of strategies. And it kept on coming back to me that, with rent to own, I guess, first of all, maybe I still had, my parents' genes a little bit, that I was a little bit apprehensive on investing. I was raised, they all worked, whether it's the government job, factory working, the laborers union, those types of things. So I wasn't used to, the investment mindset. So I still had a little bit of that. I call it the chicken poop investor, where I was a little nervous. I was a little scared. I didn't want to, take big risks. And when I saw this strategy of, hey, all these people that have been complaining or talking about terrible renters, these are people that want to own their home. They're maybe a level above the normal renter that want to own their home. So that's really great. And then the returns on, the investment itself, they were, in comparison to other normal investments or other real estate investments, they were quite attractive as well. And bottom line, the simple fact, something that I truly believe in, that was instilled for me in a young age from my grandparents, my parents, family members, that I try now to instill into, my son as he's growing up as well, is that we're put on this earth to help people. That's what we're here for. Human connection, helping people, guiding them along the way with the information that we have. If somebody asked me how to, build a rocket and get to the moon, I would say, I'm sorry, I can't really help you there. I don't know where to start. But if somebody says, hey, I want to own my home, I want to invest in real estate, I have some information that I can share and help them along the way, leave them in a better spot than when they found me. At the very least, leaving them at a net neutral, right? Of that, hey, I can't help you. Maybe I can find somebody, or hey, let's go to Florida and look for some rocket scientist or something like that. But that's why the rent to home now that spoke to me was that we were able to help people from multiple levels throughout the strategy. So I guess those are the main reasons. That I went that route or continued on with that route as well.
Yeah. And with the rent to own, I know you mentioned that your first property with your partner was in Welland in 2014. Has any of your rent to own model changed from 2014 to now?
Oh, wow. Yeah. Definitely a few things have changed. That one, I remember we looked at 4 or 5 different properties, and we paid for the home inspection. And now we don't. We have our client pay for our home inspections. But the basic model, the principle, it has stayed the same. Somebody can't qualify, a tenant buyer, that's what we call them, our clients, our tenant buyers. They can't qualify for conventional finance. There's something that the banks, the lenders just don't like. It's their income, their down payment, their credit, something that's preventing them from qualifying for that mortgage. And over a 2, 3, or 4 year period of time, it needs to be addressed, changed, saved up, corrected, claimed properly, and so that they can qualify. So the typical program is we're finding those individuals that the banks are saying no to, that are turning down. We're essentially underwriting them, looking at what they need to do over that period of time. Mm-hmm. We give them a budget. They choose the home that they want to live in, that they want to own. And we purchase it ourselves through joint venture partners. And then we help them rehabilitate credit, save up the down payment, claim their income properly so that they can qualify and go to the bank at the end of the term and get the mortgage. And then on the flip side, on the joint venture partner side, even less has changed. Our joint venture partners, qualify for financing and provide the capital, or, one or the other or both. We manage the project for them. We manage the people, the property, the rent collection, the inspections of the property, and they're making a passive investment. So the basis hasn't changed. Purchase prices, areas, interest rate, all that kind of stuff has changed and evolved. But the basic principle of our rent to own program is for the most part remain the same.
Mm-hmm, mm-hmm. There's really 3 parties involved. You guys are the middleman, like you said, the conduit. Yep. There's a passive investor that want to put their money somewhere, want to own real estate, but they want a good tenant. On the other hand, the third party is the renter or the tenant or the future buyer of this property.
Correct. Yep.
So there's really 3 parties, and you're someone in the middle, kind of make sure that they all work together. The investor get their return, the renters for now, or the tenants eventually do what they say they're going to do to build up their credit, save up their down payment, eventually take over the house. And that's a win-win exit strategy, 3 to 5 years down the road. Is that correct?
You got it. Yeah, you got it. That's pretty much, we are acting as that intermediary, that first point of contact for our tenant buyers, reporting to our joint venture partners, doing all the facilitation of whether it's qualifying the client, rehabilitating their financial well-being, as a confidant, as a business partner with the joint venture partners on saying, hey, this property is a good investment, this area at this price, helping negotiate the acquisition of the property. And then on the other end, the disposition, selling to the tenant buyer, helping them through that process, the paperwork, everything that's involved with lawyers, realtors, home inspections, all that kind of stuff, being that, like you said, that conduit, that intermediary in between that are helping facilitate for both of those clients to create a win for both.
Since we talk about that, do you mind sharing some of the numbers of the benefits for your passive investor, the benefits for your team? Of course, you got to get paid. You're running a business. Of course, you help people, but you got to make sure you get paid so you continue to supply good business. And what do they get as a rental tenant or a client?
Yeah, so we can start on the tenant buyer side or the joint venture side. So
you can use a most recent example where on the top of your head that you have something to share. Run through your example, then we all can learn.
Sure. Yeah. So let's just say we have a client, that tenant buyer now that's been approved for a $500,000 purchase price. Okay. So the bank can turn them down, but we look at them and say, okay, you know what, based on if they can fix their credit, save up more of their down payment, claim their income properly, they should be able, to get into a home in the future. But today their budget is $500,000. So they go out and choose the home of $500,000. At the same time, now we're looking for the joint venture partner that has the financial capability of buying a $500,000 home, i.e. providing the capital, qualifying for the mortgage financing, right, at the big banks or the lenders. So we facilitate that. So
sorry, before we move forward, if the tenant can already qualify for $500,000, what's stopping them from buying the house outright?
No, so they can't qualify today.
Oh, not yet.
They can't qualify today because if they fix their credit, they could. If they claim their income properly, they could. If they had another $15,000, $20,000, $40,000, they could, but they don't today. So it's those clients that have been turned down or not been able to qualify that we're working with. So that's why that they would come to us to utilize our rental solution. So so our joint venture partner, they're the ones that are purchasing the home at $500,000, just like any normal income property or secondary, non-primary residence for investment property. You'd need 20% down on the property, $100,000, right? And then typically an 80% loan to value mortgage. Now, those numbers fluctuate depending on the individual, depending on the lender, but generally that's the typical calculation. So they would provide in this case, $100,000 of capital. They qualify for the $400,000 mortgage, purchase the home. Now go back to the tenant buyer. We're putting in the plan, number one, on what they need to do: fix credit, save down payment, claim more income, and then they're agreeing to a monthly payment. So their monthly payment is going to cover very similar as if they were to buy the home today. Their principal and interest, the mortgage portion, right? The taxes and the insurance. So that's if you're buying a home, typically if you're getting a mortgage, that's what you're going to have to pay. And then the variable is how much they need to save, their monthly rent credit. So if they need to save up $36,000 over 3 years, well, their payment's going to be $1,000 on top of the mortgage, the tax, the insurance. If they only need to save up $18,000, well, hey, that's only $500 a month that they need to save on top of that. So that's what makes the payment a little bit different. But either way, we're running those numbers, giving them to the tenant buyer, saying, you're going to be able to buy this home at the end of the program. Now, here's your monthly payment. Well, here's the portion. It's $500, it's $700, it's $1,000 that is actually going to be applied to your future down payment. Do those work? Now, we know they're able to afford that because we've looked at their full financial picture. We know what their income is coming in. We know what other debts they need to service. We know what things they need to correct, and that they can afford that payment. If they can't afford that payment, then we'd say, well, maybe we need to look at $400,000, maybe go to a lower price, or if they can't afford more, go higher. So basically we get to agreement on those terms. Now, back to the joint venture partner, the payment that we set up for the client, there is going to be, cash flow, a monthly cash flow each month that our joint venture partner, JAG, that we would split on an ongoing basis in that example. So if the project is making let's just say your round numbers here, $1,000 a month in cash flow. Our investor would receive about $500 a month. JAG would receive $500 a month. And that would be the cash flow. So that's one of the benefits, that our joint venture partner receives cash flow from day one, right from the beginning of the program to the length of the term. Okay. And then the second piece, again, back to the tenant buyer, we're setting a predetermined price. So that $500,000 home today, we're going to sell back at an appreciated price that's predetermined at the beginning of the program at $600,000, let's say.
Usually,
right?
what's the percentage you guys use per year for annual appreciation?
Yeah, again, typically we're going to look at the area, the region, but somewhere around 5% or so per year is a good barometer. We, in some cases higher, some cases lower, but 5 is a good number to kind of bookmark in there. So we're selling it back at that appreciated price into the future. And again, we know that they're going to be able to qualify and buy because, again, we've looked at their financials. And essentially, that's how we've set the budget for them today, is based on what they can buy 3 years, 4 years into the future. And so that's another benefit for our joint venture partner on the end, is that now we're selling it at an appreciated price. It's almost, I always tell the story about that study that they do with young children about, you can have one marshmallow right now, or we're going to give you 5 marshmallows if you wait 10 minutes, right?
Yeah,
so you're waiting that 3 years or 4 years into the future, and now we're selling it at that appreciated price. So that's the second portion of the profit, is that they're going to receive the lift from after they, obviously pay out their first mortgage, receive their initial investment that they've gotten back, and then that profit at the end.
So, question for you: where is that $1,000 cash flow split between you and your investor coming from?
Yeah. So again, there's a premium on top of the mortgage, the tax, the insurance payment, just like any other business, like a coffee shop, buy for one, sell for two, right? So we're getting, I'd like to say, A lending, AAA lending, because of our joint venture partners, because of the capability of the mortgages, the financing that we're able to qualify for. So the clients can, take advantage of that. So there's a premium on that payment. And then as well as the monthly rent credit that's credited back. We're collecting that today, right? And we're able to spend it and use that. However, we credit it to them in the future, because we've gotten it already. We've used it. We've spent it. That's the cash flow that we're getting. And then at the end, we're crediting the tenant buyer, that client, for that money that they've given to us at the beginning, as well as what they've collected or what they've, their additional rent credit payment is throughout the term.
Do you mind if I ask, like, the monthly rent credit, let's say is an extra $1,000. You guys say, hey, you know what? $1,000 per month, $12,000 per year, 5 years, you got $60K. Okay, maybe not enough, maybe a bit more, $1,500 per month. Is that you? I know you guys collect it. You guys kind of like a bank. They trust you that you guys will give it back to them. Yes, you guys kind of like a bank, but it's a cash flow within that, or it's kind of like a cash flow?
That's a portion. Yeah, that's a portion of the cash flow, because we have a written agreement, a purchase option contract, stating the tenants have given us a certain amount to enter the program. Their initial option consideration. For any purchase option agreement to be valid, there has to be consideration given. So number one, their initial deposit that they've given us, $20,000, $30,000, $40,000 at the beginning, and that we're going to credit that back to them when they purchase, as well as their monthly portion, whether it's $4,000 or $5,000 per month over the length of that 36, 48 months, that we're crediting back to them at the end. So that's in the agreement, in the contract at the beginning of the term, that is protecting the tenant buyer as well as protecting us. When they purchase the home, they get that credit at the end of the term.
Got it. So do you mind if I ask, what does JAG Property do with all these cash flow and the money upfront that they pay you guys? Not the $100K, but let's say $30K. They pay you guys $30K every month. They pay you guys another $1,000 of monthly rent credit. What do you guys do with those money and making sure that you guys can return it 5 years down the road?
Well, first of all, so that initial option consideration that the client's giving us, that's actually being applied to purchase the home. So that's going right into equity into the home. So our joint venture partners, our investors, get the benefit from that money. So that example of the investor needing $100,000 and $400,000 mortgage, their net investment might actually be $80,000 or 75 because the tenant buyers provided $20,000 or $25,000 through the program. So they get the benefit. So it's actually an equity into the home. The other part, the monthly rent collection, that's also into equity in the home because we're selling it. When we sell it to the client at the end of the term, it's being credited back as a line item at the lawyer's office or the closing, because now they've given us whatever numbers, whatever figures we want to use, an X amount at the beginning. We've collected, another X amount throughout the term, and now that's being credited back. So that's a security to make sure that the client, we're not going and, just going and spending this money. It's in equity into the home that we've built into the program that's being credited back and to the tenant buyer at the end of the program, so that when they go qualify, they've got good credit, they've got their income, and now this completes the deposit or down payment portion of their qualification for the bank or lender.
Got it. So you guys don't really spend that money, actually go in. And then what do you do with those money? Just sit in an account?
No, the monthly, that is monthly cash flow that we're collecting every single month. We're returning it or crediting it back at the end of the term. It's like the example I always say.
Where does that money come from? From the next property or?
No, from the tenant buyer, from that tenant buyer. They're paying that every single month, part of their portion that's coming into that. And now it's in that lift, that $500,000 to $600,000 purchase. If we have to credit them $30,000, that's in that lift because we pay out the first mortgage, we pay the investor back their initial investment, we credit the tenant buyer, and now there's still a profit to be split at the end.
Got it. Okay. I think let me recap. You guys are the financial advisor or the planner kind of thing, conduit between both. Tenant pay a bit more for a hope that you can own a house 5 years down the road. Not now. You guys pay us a down payment and get paid as a monthly rent credit that goes towards some of the benefits down the road. I just did a quick calculation here. $500K, 1.05, 5% appreciation for 5 years compounded. This is about $640K, right? Number sounds familiar to you?
Yep.
And then, $140K lift, of course, this is leverage because you guys only put 20% down. So there's enough to go around. Is that a typical deal that you guys do?
You got it, Cody. You know what? It's kind of surreal being part of the podcast because I've heard you break down numbers with other investors and people that you've had explained. So I've understood it when you've interviewed other guests on your show. So you got it right on the mark there in terms of there is enough to go around there. That money's come from the lift. And you got it. And again, kudos to you because this isn't, a simple concept that takes a few times. I know when I was going through the education, I had to take the rent to own class 3 different times to understand all of it. So for you to pick that up, that just goes to your intelligence and why you're so successful at what you're doing as well. But you hit the nail on the head precisely there.
Thanks for the compliment. Now I got to throw your curveball a little bit to keep it real. The market dropped substantially since last year.
Yep.
Are there any tenants come back and be like, hey, the price dropped, so maybe I won't go through the contract with you guys, so I might as well buy it now because it's 30% cheaper?
Absolutely. So we've definitely fielded some of those phone calls where a client that entered into our program in 2022 or end of 21, and hey, I bought this home and now it's gone down. And we said, well, hey, you're in a 3-year or 4-year rental program. You don't have to buy it today. You have now another 2 or 3 years for this market now to kind of go back up. And again, nobody can predict the market. So the thing that I've been, that lets me sleep at night, allows us to put our tenant buyers' mind at ease, our joint venture partners' mind at ease, is that, yes, from last year over year, yes, the numbers are down. Purchase prices, real estate, those are. But look back even 2 years or 3 or 5, numbers are up, right? If I said to you, Cody, hey, let's Back to the Future, let's jump into our DeLorean and go back 5 years or 10 years. And would you want to shop at those purchase prices? I'm sure everybody listening would love to say, hey, let's go back 10 years and buy houses or properties at that price. So that's the thing, is that our programs are 3 or 4 years in length, typically up to 5, maybe in some cases. So it has that time frame for maybe to go up, to go down, for it to go back up into elasticity. Now, to address the issue, if it does, the perfect storm does happen. and you are supposed to buy, and now the home is not appraising for the agreed upon purchase price. The client's done everything that they needed to do. They fixed their credit, saved up. They've been great, but the market does what the market does, and the home doesn't appraise where it needs to appraise. So let's use the example. They need to buy at that, I don't know, $600,000 purchase price, and the property now maximum appraisal is $575,000. There's a $25,000 shortfall.
Correct.
First question we ask, there's a few different options, but does that tenant buyer have a $25,000 additional savings to make that, to close that gap? Right? In most cases, they won't, because they wouldn't have anticipated that. So that's not necessarily an option, maybe in some cases, but not particular.
No.
The option that, again, we haven't encountered, it's just because Ontario specifically has been almost like on a 90-degree increase in terms of purchase price, the first little dip that we've seen. But in Alberta in 2017, 2018, they encountered this exact thing where purchase prices came down, oil, all that kind of stuff. And again, we didn't transact or work in Alberta. These are just stories from other counterparts, other companies. Again, I'm very prevalent in the industry, like to see what others are doing, take best practices, learn from experiences, right? So what they had done was they extended the program. So now 3 years have come. You're supposed to buy it fixed. It's only appraising at $575,000. What do? Let's extend a year, 6 months, a year, 18 months, 2 years for that property to get back up to that $600,000 mark. Because the tenant buyer, they've done everything. They've been good people. They want to own that home. Yeah. Let's wait till that price goes up there. They still want to be in there. Let's wait now till the prices kind of readjust. And then when they do, that's when we enact, and then we sell the home to them at that point.
Yeah, this is actually really smart, because at the end of the day, I'm guessing this is a business. So if they say, you know what, I'm actually just going to break the contract, go buy this property myself or whatever, then I guess there's a certain privilege and down payment and the money they put in as a tenant that they're going to lose as well, right? Is that correct?
Right. Correct. So it's an option. And then that's the other case too, is that it's an option, not an obligation to buy the home. So they have a purchase option. If they say, this home's only worth $575,000, I'm not buying it at $6,000, I'm out of here. Okay, that's your prerogative. That's your choice. You can walk away. However, we would walk them through the best examples if they still want to live there. Right?
They're not going to get the money back, right? They're not going to get the money. Contractually, it's a non-refundable option consideration. We'll work with tenants. We're not in the business of just taking deposits. No, we want to help people own their home. But in those cases, that would, again, just like any other contract, you would lose deposit if you didn't enact or that purchase, or, offer deposits when we're buying properties, things like that. Yeah. Like for listeners, I'm not trying to grill Alfonso and say, hey, rent to own is blah, 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 predatory on anyone. The reason I ask that is because when shoot hit the fan, most people, human nature, come in as a tenant and be like, why don't I go buy it myself? Okay, if I do that, I don't go through the contract, I can lose certain part of my money, if not all. For you guys is, hey, we did all the hard work, can't do it, you guys, running as financial advisor. We need to keep the lights going on, and we're doing great work. At the same time, we do have a joint venture partner that they put in their time, money, and sweat and trust in you guys. So for you guys to come to the middle ground and say, you know what, guys, we can't predict the market, but in the long-term market has been going up 3 to 5% per year. Maybe 3 years is not enough. That has happened to Calgary after the 2014 oil price cut in half. Take that as an experience. They already have success to how they adjust to it. So now in Ontario, we're going to do that as well. We're not trying to take your money and run, but hey, this is the best solution that you can still hit your goal just a bit longer, and our investors still be happy, and you guys are happy as well, right? Is that fair to say?
Absolutely. You got it. And that's what keeps both parties accountable, where both parties feel like they got the better end of the deal, or that they could have got something more. That's when a good partnership or a good, transaction or a good deal is made, is that both parties are accountable. The investor is making money. I could have made more. Or the investor is saying, I could have bought it for less. But both are successful at owning the home and getting really good returns as well. So that's what we try to do, is partner those up as much as we can, so that both parties are walking away saying, hey, this was successful. This was worthwhile. And both are benefiting.
Hey, what goes around comes around. Not saying it's a karma thing, but when the market goes up, your joint venture partner is probably angry at you guys. Why do you cap at 3 to 5%? And now the tenants come back and say, hey, guys, it's not appraised of what the price is. So
Yeah. And you got it, right? Like you saw the big spike over the last 2 years of 25% appreciation in some markets where we're using a very conservative buy. Tenant buyers are, like skipping, right? They're happy. Yeah. They're super excited. However, our joint venture partners, I'll tell you, they're still happy as well. Sure. Oh, could we have sold it for more? Of course. Everybody, the greed factor said
the money that I did not get, that I'm supposed to get. But come on, guys.
That's right. But again, the monthly cash flow, great return of investment. There's still profit made there. Could there have been more? Sure. But that's when we get into timing the market where nobody can predict. Nobody knows where the ceiling is. We don't know where the floor is. It's always constantly shifting. We can only know that once we look back, right? Look back and like, 10 years ago, we should have bought more. Again, being from Hamilton, there was properties that were going for $70,000, $80,000 when I got into this investment. Now they're minimum $500,000. I'm like, why didn't I buy 20 of them? Right? I thought $80,000 in downtown Hamilton. No way. They're never going to be worth more than 100, 150. Why didn't I buy more? Right? But that's the hindsight of the advantage of that. Right? In the moment, we have to take our best guesses with the information that we currently have available.
I know you're a rental expert. I know you put down 2 other vehicles of building your income. Do you want to touch a little bit on your passive real estate investing and the real estate instructing side of things, just in case some of our listeners are interested in that?
Sure. Yeah, I'll kind of highlight a little bit of just the passive investing where, like I have just the normal rental units, buy and hold, duplexes, triplexes, that rentals in there, that, a little bit of a blend of, self-management versus, having management professionals in there, which again, I benefit and I look back on saying I should have bought more, should have got more units, should have bought the one next door as well, right? However, I don't regret it for a minute of the deals and transactions that I've done. Again, that's been a great way of, again, helping people into home ownership, just renting. And I always look at it as, hey, are any of those renters good candidates to get them out of my rental unit into a rental home? So now that I can put another renter in there at current market rent. So that's the other element, right, in there.
You're genius.
Right? Because I
you're helping people too. And you make more money at the same time. So, hey, that's makes a lot of business sense. To me,
that's the perfect storm. If you can help people and make money, it doesn't have to be mutually exclusive. We shouldn't have to make money by hurting people, by doing something fishy or scammy. And we should benefit from, expertise, knowledge, advice, services, products that we provide. Right. So, that's where we're partnering the two together. So the passive investing, which is, I kind of almost say like 70% passive, because I still am involved. I still have,
you have to manage the management company.
That's right. Yeah.
Or the construction.
You have to manage the managers. Right. So, and then, so that's been a huge asset. That's been, passive income that, whether it's quarterly or annually that you're taking it, there's equity in there that I haven't refinanced a lot of these properties because I'm like, why not keep that mortgage as low as possible, keep the cash flow up. Sure, one day let's refinance, pull some money up for a bigger project for something like that. However, if we can keep the expenses low on that and bring in more cash flow and raise rent, that's another way to generate more revenue by not doing much or much effort either. So,
would you consider refinance those at this current state? Because there's a lot more deals out there, even though the rate is high, but a lot of people think that buy now, down the road, when interest rate come down, the price recover and you're winning, right? Would you consider refinance now?
It's been a thought. It's been a thought in my mind. The current ones where the rates that we have and the payments that we are, it'd be really tough to be like, wait, we have to pay more and then we shrink our cash flows. But again, you're right. The access to that capital to go put into another project that you cash flow. And then, in 3 or 5 years. So maybe we'll be talking again in 5 years from now. It's like, should have refinanced and bought more in 2023. But again, that's to be remain. I'm always looking at growing that portfolio. But I would consider it. I wouldn't completely rule it out and say, no, I would never, just because of an interest rate. To me, an interest rate is just the cost of doing business. If I can pay 20% interest, but I can find a deal that makes 35, I'm still winning. I'm not looking at, I had to pay 20. People might say, you're crazy paying 20% interest. But if I can yield a 30 or 35, then why wouldn't I? It's just, again, cost of business, right?
Yeah. just have to watch out. The higher the interest rate, the higher the cost of that, there's less margin of safety. That's a word for it.
Correct. Yeah, no, absolutely. And you're more susceptible to market fluctuations, things like that. Things come down, that equity in that home squeezes. I like, maybe it's my mindset. There's other people that think, maximize, refinance, pull out the maximum you can. I like having equity there because I'm saying worst case scenario, if everything goes to zero, which I really don't think that would ever happen. But if real estate cuts in half, everything in value is just dropped. I have equity in there. Right now, I'm not upside down that I owe more than it's worth back to a 2008, 2009 type of situation in the US, right? So having a little bit of equity or significant equity, it's everybody's comfort level, but I like having that into the...
What is that loan to value that you're comfortable with? Mine's around 50%. I mean, I don't know about you.
Yeah, I was just going to say that. Probably around 40 to 50% in that, leaving that there and just, makes me sleep easier at night saying, you know what, if, I don't know, government changes policies or rules change or banks do this, do that. Hey, I only owe this much left on it. It's worth this much. I'm still okay. Right. Versus, hey, I'm maximized. And now property values, I'm looking at what they're doing. Obviously, it's my business, it's our job, it's what we do. But I'm not as intent of like, oh my God, I'm not fretting about it. I don't have any hair to lose. So I don't want to be stressing about that kind of stuff. I don't want to be losing any of my facial hair about this kind of thing, right? So I'm looking at it from a different perspective of, hey, okay, this is what rates are doing, this is what prices are doing. But in my own personal portfolio, hey, I'm secure, I got equity. In a worst case, I'm safe or we feel safe, right?
Cool. I know we can chat about this kind of topic for a very long time, but we only have a few minutes left. Out of the fire round, I'm only going to pick one question.
Okay.
Are you ready for it?
All right. I think so. I'm ready.
If you lose everything, all your 250 rent-to-own properties, the partnership, all your personal holdings of real estate, but you have the reputation and knowledge, I drop you of $500,000. What would you do to start over today?
Yeah, right off the bat, I would go find a rental property, a rent-to-own property. I would invest some of that $500,000. Again, we were talking just before we started recording. U.S. investing, right? Where can I stretch that capital the farthest that it can go, right? Where can it go, right? Again, having all the knowledge, having the expertise, having everything that I've already know, I think I would be able to scale back up, even quicker than I have in the last, 10, 12 years of doing this type of business. So that $500,000, probably put it right back into investment. I would probably go the passive route much quicker because then I would know how to decipher who is, actually telling me the truth and who's actually not, and kind of being able to decipher or underwrite those types, but definitely a passive. I'm still young. I want to relatively young, I guess. You guys have a young listenership as well too, so you guys might think I'm old. I think I'm young. I'm in my mind, I'm vibrant. I'm energetic. I'm healthy. I want to still be working, right, contributing to society, adding that. So I would still want to have some active type of investment, things that I'm doing, projects that get me excited, that I'm learning more, expanding my horizons, expanding my knowledge. Like I said, US or maybe development or things like that are appealing to me. But definitely, as soon as possible, getting into some type of long-term hold. Definitely put it back into a one or two rent-to-home deals where, again, I can help a family, get into home ownership and get those returns. So, yeah, I don't know how I'd exactly allocate that, but definitely passive, some active, and
more rental.
And probably the first little bit of maybe like a quick little getaway to be like, oh crap, I just lost all this money. I'm gonna go and just relax and take a deep breath here, but let's and regroup and maybe work with strategic business plans or things like that to put or planners or coaches so that I could do that more with more velocity than I would in the past. So I hope that answers that question. I'm not sure how quick of a rapid answer that was, but I hope that helps.
No, this is really good. So where can our audience find more about you?
Yeah, first and foremost, get on to the website, jagproperties.com. That's J with 2 A's, gproperties.com. You can reach out to me directly, Alfonso at jagproperties.com. That's my email address. You can find all the contact information on the website, obviously social media channels, all that good stuff. Not as active or as amazing as Cody on YouTube and all the content that he's producing, but more and more putting out more information about what we do and how we work. So yeah, we're not hiding. Jag Properties, Google us, find us, and happy to have a chat and then go a little bit more depth for your specific situation.
Great. And then when this podcast go live, our post-production team will tag your Jag Property Instagram as well, so people can see the teaser as well.
Wonderful.
Okay. Well, any last words for our audience? Last words of wisdom?
Wow, lots of words, but if I can distill it down to a few things, keep listening to Cody. He's got a great track record. He's got amazing information, knowledge, but that's just one piece of it. The information, the knowledge, you can get that from numerous amount of different sources. But putting it into action, applying it on how you want your life to look. Right? Because I can tell you rent to own. Cody could say another investment strategy. The next 50 guests that Cody has on his podcast could give you all the different strategies. But it's how it's going to be applying it to your life and what you want. So
the lifestyle.
Start with that lifestyle. Start with that end in mind of how you want your life to look, or at least how you want it to look today. Because in 6 months, a year, as you start developing, things change and you might want something different. So having that in mind, because the go-to one, the easy one is, hey, take action. And that's easy to say, but take action that is specific for your life and your situation and go at your own pace. You don't need to do what Cody does. You don't need to do what Alfonso does. You don't need to do what anybody else does. You need to do it the way that it makes sense for you, the time frames, the investment amount, the strategies, and really define that for yourself. That's the most important thing. How you go and do it? There is 1,000,001 different ways that you can do that, but find what's important to you, whether it's time, whether it's travel, whether it's experiences. Define that as best you can, then move forward with the action and the steps that you're going to take to actually implement it.
Love it. Love it. Here you have it. Alfonso Salemi, the experts from rent to own and the lifestyle and really the financial advisors putting multiple parties together. Kudos to you on that. Keep killing it. And there's always opportunity. So thanks for coming on, Alfonso.
Thank you.
Well, want to have you back maybe 3-5 years from now to talk about that, maybe whether you refinance or not.
Sounds good. I'll put it in my calendar.
Okay. Ciao.
Thank you.
All the links mentioned in this episode are included in the show notes. And if you love this episode, please leave us a rating and review on Apple iTunes. The link is also included in the show notes. And we would really appreciate your help in spreading the word to more high income earners on how they too can maximize both their time and money.
Also, if you still haven't joined our High Income Earners Facebook group, you are missing out on High Income Earners community where we help each other reach our own version of FIRE.